I think the S&P 500 can go back to 3,000. And I think in a normal correction, it goes back to 3,000. See this rally here is the things I remember seeing back in 2007 and 1999. Markets get too expensive. I think gold is just a matter of time to go to 3,000. And here's one thing I misunderstand about the U.S. system. It's what Churchill said about the U.S. The Americans always come to the right conclusion after exhausting all available options. The number one traded crypto is Tether. That's a U.S. dollar token, $110 billion. Now, if you're in the U.S. and you're a regulator or legislator, are you dumb enough to mess that up? It's a lesson in life, and certainly when you're dealing with China. Ignore what they say, watch what they do.
Today we interview Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence. Welcome to the show, Mike.
Thank you, Kevin. It's good to be on.
Good to have you. We have an extremely eventful week this week. Dow Jones fell 1.49%. We have the Federal Reserve rate decision today, actually, as of the recording time, 7 p.m. UK time. We'll have Apple earnings Thursday, so tomorrow. A lot of things happening this week. Obviously, we're all watching the Fed decision. Fed Chair Powell is expected to reiterate a more hawkish stance. On the short term, Mike, what are you watching? What's interesting to you?
The short term and big picture, everything to me is about beta. And by beta, I mean the U.S. stock market, the S&P 500. It looks like it's basically topped. The only question is it started to roll over. It's a question of the duration and the extent of the drawdown. If it's rolling over like I think it is, then all the dominoes tumble, meaning yields, commodities, virtually all risk assets on the planet. The reason I say that is because it's, in many measures, the U.S. stock market's the most expensive ever you can even go back and by many measures, the most expensive ever in history. So to me, that's the number one thing that's going to matter. And then everything else is noise. We have, as you mentioned, the Federal Reserve will not be hiking or cutting. We expect Chairman Powell will probably be hawkish. That's kind of priced in the market. And we've had potentially peaks in commodities, peaks in crude oil. And the one major asset that closed at a record high at the end of April was gold. So I remain bullish gold. I remain bearish crude oil, and I'm very concerned that if the U.S. stock market rolls over, all the dominoes will tumble. That's an if statement. We have to see if that'll happen. Obviously, my bias is somewhat I think it's more likely to be rolling over. And in this interview, I'll show you why.
Interesting. So we want to get your take on gold and oil for sure later. For now, one quote, the boss of one of the world's biggest banks has warned U.S. interest rates could climb to 8%. Jamie Dimon, the head of JP Morgan Chase, said his bank has prepared for interest rates to jump because of persistent inflationary pressures. Do you agree with this?
No. I don't know why Mr. Dimon said that. I'm a big fan of his. But no, not at all. It's very likely that I think U.S. rates will follow the example of the rest of the world. I'm just pulling up on the terminal right now, rates in the world bond rates. In Germany, the 10-year yield is 2.6%. In Canada, it's 3.7%. In Greece, it's 3.6%. In China, the most significant second largest country in the world, 10-year yields are 3.5%. In the U.S., they're 4.6%. So U.S. is the highest in that space. That's also a major force for dollar strength, which is crushing most other currencies in the world. We're seeing Japanese having to intervene to help suppress the declining yen. We're potentially going to see the same thing from China and in Europe. And that is, rates are already too high in the U.S. for the rest of the world. This is creating a strong dollar, which is breaking the global economy. It's also going to be showing signs of slowdown in the U.S. So to me, that's a factor. I don't know why he said that. Maybe it's a warning sign, but I think the next big trend in the U.S. is for U.S. 10-year note yields, which are right now about 4.64%, to drop towards what you see in Germany and China, means drop towards 3%.
The S&P 500 is at 5,020.83 right now. How many cuts are priced in?
In cuts, let's work on our WIRP function in the terminal. So for cuts, we have to go out. This shows the rate cuts. The meeting that we're having today, as recorded May 1st, shows nothing. You have to go out to really showing more than an 80% chance of a 25 basis point cut. You have to go to November, which is dicey because it's the month of the election. You really don't have it to December. But that's the key thing, as you see in these bars here, is we've been pricing for cuts for over a year, and they've been wrong. I like to give the example at the beginning of last year, 2023. I always look at futures a year from now. So at the beginning of 2023, the futures, Fed Fund futures a year from now, started pricing for 100 basis points of cuts. And that was at maybe Q1 2023. And last year, the Fed still hiked another 100 basis points. So this is an indication. And I think here's the key thing why I think the stock market's going down. It's a high price cure. Stock market's going up, inflation staying sticky. And that to me means that I don't think the Fed's going to cut until the stock market goes down and deflates and tells the Fed to cut, which is where I think we're heading right now.
Interesting. So do interest rates even matter anymore? Is it?
Oh, sure, of course. Significantly, I use the example of what's happening in Japan. Japan has very low interest rates, and they're having to support their currency. The Japanese yen is plunging. Last I see it is a 157. That's just on a one-year basis. That's declined 13%. Imagine every single asset, the whole value of the Japanese economy declined 13% versus the U.S. Japan's 10-year note yields are still very low, 0.88% or almost 0.9. They don't even have a handle yet. Your handle would be a 1 in front of it. And that, to me, is an example of interest rates breaking. In the U.S., the mortgage market seized up. And I think what we're seeing is just a delayed reaction, which is sometimes the worst, to the biggest liquidity and money pump in history. And the long and variable lag to high interest rates will kick in at some point, in my view. And I'm seeing that in commodities. We're seeing pretty severe deflationary forces in commodities.
On the other side, you could argue that these high interest rates are not really pinching Americans who own assets like houses and stocks as much. So these kind of demographics are not affected by them as much. Is that something that we should take into account? Should we look more at balance sheet activity of the Fed?
I don't. That's kind of more peripherally. It's the overall interest rate that matters. So right now our Fed funds rate is 5.33%. And the 10-year note yield is 4.65. That's an inverted curve. It shows that deflationary forces. And I think what you're seeing is just more the delayed reaction. But yeah, they matter more than ever. It's just the delayed reaction, I think, is the significance. But what you mentioned is quite, I think, important is we've had that wealth effect. In the U.S., typically people can lock in for 30 years for a mortgage rate, and you don't have to have that interest rate risk, which is not the case in most of the rest of the world. They have adjustable rates, and most people have. So U.S. balance sheets, consumer balance sheets, are quite favorable, and they have had the wealth effect. I'm in Miami, an average home in this country has basically doubled in the last 10 years. In Miami, in the last 5 or 6 years, the average condo or home has doubled in value. So people feel rich. Stock market's at record highs. They feel wealthy. That's why I think the problem is we're not going to see those deflationary forces or disinflation really accelerate until assets go down. And last time when this happened, it started in 2006. The housing market peaked and went down first. This time, I think it's going to be the stock market. I think we might be on the cusp of it rolling over. We'll get to that later. But to me, that's what's happening. You have to reverse some of the wealth effect, which came on the back of COVID and the big pump in liquidity and all the money that the U.S. government threw at its citizens. At some point, the hangover is going to kick in. It just hasn't yet.
Maybe let's dig into that right now. When do we know that this hangover is going to kick in? What indicators should we be watching?
Start with the stock market. It's already starting, I think. But I think the stock market it's the number one leading indicator for risk assets and irrational exuberance and things like that. So I look at the S&P 500 total return this year is 5.7%. Gold's 12%. So gold's doubling the return of the S&P 500. That rock beating stocks, as Warren Buffett says, it's not a good sign. And remember, the stock market's that AI-driven enthusiasm. And so I'm more biased towards the gold market's telling me that there's going to be a problem. And I think it's just starting to roll over. And it's just a question of all those inflection points and iterations. So what I'm showing you in this chart is I just show, I think, the S&P 500's rolling over, and I'm overlaying with crude oil. Looks like crude oil's rolling over too. But there's another chart I want to show you and tell you why. The key thing I'm concerned about is volatility. If you look at indicators from volatility in the U.S. market, volatility in the U.S. is very low and interest rates are very high. So typically that's a bad indication for what's going to happen is when it mean reverts higher. And then we also have things that we'll discuss. I think we mentioned pre-show is the interest rates in, like I mentioned, we just showed earlier, interest rates in China are collapsing, which shows deflationary forces.
Yeah. Earlier you talked about the inverted yield curve. Now, this seems to be one of the examples of indicators that used to matter but don't anymore. I want to know, first of all, maybe we can explain inverted yield curve for those in our audience that don't know what that is, why it matters, and then whether there's other indicators that, used to matter, but we don't really watch them that much anymore.
So the inverted yield curve is when a bond in 10 years, which I show you here, this is the U.S. 10-year note yield, in 10 years at 4.65%, when the yield is lower than a rate or T-bill or a bond that's good for a 1 year. Right near 1 year rates right now are about 5.3%. And that shows somewhat inflationary forces now. But when a 10-year note yield is lower, it usually means it's a market's expecting more deflation or lower inflation in the future. And it's also an indication of deflationary recession typically. Now, I don't think it's no longer matters. I think what's happening is we're getting that classic example of remember, we've had some significant 100-year events that just happened in the last 2 years. First, we had COVID, and then the unlimited friendship between Russia's the President Xi and Russia's President Putin, and then the Russians' invasion of Ukraine and the Israel-Hamas war. And there's a lot of things like that are just all kicking in that are distorting some of these indicators. But the biggest thing was the biggest money pump in history. And this is what I'll show you on this chart. This is M2 money supply year over year. I love this chart because it shows you how significant what happened in the U.S. I'll just hit max on this. Money supply is running negative 0.3%. And we had this big pump. This was COVID. And it's all the lessons of history is when you pump liquidity too much and you pump up assets too much, they respond. But in the long term, you have to expect a hangover. And I don't think that hangover started yet. So it's just part of the distortions of history. From this, I go back to 1960 and this, we just have never had this. And here we are. So it's one of those things that you learn in school is that the questions are the same, but the answers have changed. We're just learning how to navigate with this new global economy. And my tilt is towards quite a pretty severe deflation on the back of that significant inflation, which is a normal cycle in history.
Yeah, truly something that we have never observed historically, pumping so much money into the system. So we have some people, and this is actually an audience statement or an audience question we got, a recession would be good to course correct. And this reflects the sentiment of a couple of more people, I guess. Do you agree with that?
In some ways. I'm right now on my chart, I'm showing leading indicators. This has had 100% probability of showing recessions in the last, this is 60 years. And leading indicators is below 5.5%. In magenta, these are recessions. Every single time it gets this low, we have a recession. But no, I think it's might be a good reset. It's not good politically, but I think that's what we need. It's just a normal reset that we don't just throw money at the system. Let things happen more organically. So I think that's what thing is going to happen. There's a author named Jeff Booth. He wrote the book The Price of Tomorrow. And his quote is, humans are typically about series of error corrections. And we learn the lessons of too much liquidity inflation. I showed you in that money supply chart earlier. I think hopefully we'll learn that from that lesson. And the next time we have issues, we won't throw that much liquidity at the market. which means we'll probably have more enduring recession, and things will come out organically. And that's the thing I'm worried about. This is what happened with the 2000 financial crisis. Leading indicators were really deep. The market collapsed, and it's threw tons of money at the system. And now we have the inflation that we're suffering from. So I think that's going to happen. I think this leading indicators is going to be right. It hasn't been yet. And then it depends on how it works out. But what I'm worried is it's going to be pretty severe deflationary.
Now, this might just be the correction or lesson that we need, as you say, but what are the chances that we get into a stagflation, something that would be a little bit more dangerous? And maybe we can start with explaining a stagflation to our audience and then explain what is the probability we get there.
I think it's very low. The latest data in this country shows stagflation. That is when you have a stagnant or slow economic growth and increasing inflation. So, for instance, the GDP numbers came out a little bit expected around 2% for the Q1. It came out 1.5%. And the inflation numbers came out a little bit higher than expected. So that shows slowing economic growth, or slower than expected, and higher inflation than expected. Stagflation, i.e. stagnant economic growth and inflation. I think we're in the midst of the soft landing right now, and we're going to transition to a pretty severe recession. Now, it's already happening in China. Certainly, if you look at some of their data. It's happening in most of Europe, Canada, Germany. And it's just a question of when does it get resolved? And that's why a lot of central banks, certainly Chinese, are cutting aggressively. Germany, most of Europe is on the cusp of cutting their rates. But I think it's unlikely we're going to get stagflation. I think this is the transition from the severe inflation we got because of COVID and the massive pump in liquidity, transition to the normal cycle towards deflation. And here's usually how it works. It's the base that matters. So if a price of a home in this country goes from $200 to $400, $1,000, that's inflation. But if it gets up to $400,000 and then drops to $350, that's deflation. It's the base. The base is so high now. We have so much liquidity in the system. We pump so much liquidity in the system. I think it's more likely to tilt lower. And I've already clearly seen that in commodities. So I'll mention crude oil. Crude oil, WTI crude oil right now is $81 a barrel. That was first traded in 2007, that price. That's a severe deflationary force in terms of the commodities. So I think it's going to trickle down to everything. And basically the bottom line is what we started out earlier. That's why it's so important that the U.S. stock market has to stay stable, go higher. Because once the U.S. stock market goes down, I think it will, it'll tumble all the dominoes for deflation, which is a recession, which I think is overdue. Obviously, these are my views, and that's what I'm paid to do, is have a view.
Yeah. So let's put on our negative hat there, okay? I want to zoom out, look at the big picture, and look at what are the biggest risks right now. And you mentioned that if the stock market starts tumbling, it might get ugly. If you really, think in terms of worst cases, what do you see as, potential black swan situations?
Let's start with levels. So that's what I'm showing on this chart. If you look at the S&P 500, basically the world's measure of risk beta, divided by the U.S. GDP, it's the highest right now since 1930s. I do that on a ratio basis. Now, we had a little peak back here at 2021 before the Fed started hiking. That was on the back of all liquidity. But see how expensive it is? I go back to 1960 in this chart. At the same time, I take the S&P, the Bloomberg Commodity Index, and I divide by S&P 500. It's the cheapest it's been in 25 years. So see that's a pattern that I love to call the crocodile jaws. I'm in Florida, so got crocodiles. And, it's when something's really expensive and something's really cheap. So the stock market's really expensive, commodities are really low. We've seen the opposite here in the 80s. We've seen similar here in 2000, right before the internet bubble collapse. And I suspect that's what we have to look forward to is simple mean reversion. And so I think it's the most important thing to remember in markets is mean reversion is the most powerful forces in markets. And typically when you get this expensive stock market and this cheap stock market versus commodities, or commodities versus stock market, it only takes a catalyst. Now, what's that catalyst going to be? I don't know, but I think it's already starting. And it started with President Xi's unlimited friendship with President Putin shifted the world order. I mean, it's every major global economy and country companies doing everything they can to get out of China. Certainly in this country, it's complete agreement on both sides of the aisle in D.C. to bash China, and rightly so, I think, because they declared us as an enemy. I'm like, okay, well, kind of a silly thing to do to your best customers is piss off your best customers, but oh well. Europe and that's what their best export customers, so they're getting out. So I think what's happening in China is a pretty severe recession. No, I'm sorry, it's not recession. It's a normal reversion of a rapidly expanding emerging market, very similar to what happened in Japan 30 years ago, and similar to what happened to the Soviet Union about 30 years ago. It's just getting started. So to me, that's what's going on. As far as the main catalyst, it'll be when the U.S. stock market goes down. It's a question of when. Then all the dominoes tumble. And that's what I'm showing you on this chart. I'm showing you what I think is one of the best leading indicators, and those are government bond markets. So you look at the Chinese government bond market, it's dropped to a new low yield. We have data going back almost 20 years. Certainly it's dropped on a low it's kind of converging with Japanese government bonds. Now, I used to work for Japanese firms. Japanese bonds really started plunging in the early 90s and have stayed low. But now China is turning towards, basically it's that quote that we're all turning Japanese. Well, China is. Their stock market as a percentage of GDP was about 2 times GDP. It was about the peak in Japan when Chinese stock peaked a few years ago. And the real estate market was about 4 times GDP, which is very similar to what happened when Japan peaked 30 years ago. And it's still starting to revert lower. But the Japanese didn't support a war or, push against its best customers. So to me, that's what's happening in the macro. That's why it's really bearish for commodities. And that's why I think the U.S. being a outlier in that is just going to not matter. It's going to not, it's inconceivable it can really last that much longer. I think at some point, the whole global economy kind of tilts towards a normal recession. And that's why the U.S. stock market matters so much. So what I'm showing in this chart is the JGBs have, CGBs, these are Chinese government bond yields, have plunged versus JDBs. This is the lowest spread in our database. And at the same time, I show you in orange, this is the Bloomberg Commodity Index. It looks like it could drop another 40% to get to its upward sloping trend line. And I think it's going to be rolling over. And I've seen that in crude oil. I've seen that in copper, corn. And the only major commodity that's going up is gold, which is what you'd expect, partly because the most significant buyer of gold is China.
I know it's always difficult to put a timeline on these kind of things, but what's your best estimated guess?
Don't know. Last year, I have to admit I've been wrong. I did not think the stock market would make a new high, but let's see what I think. It's going to all depend on when the U.S. stock market rolls over, which I think might be happening now. And I didn't think it'd make a new high, but I think that's a mistake that Chairman Powell made last year, is he pivoted towards saying he will be easing too soon before we really saw inflation meet its target, and it just goosed the stock market to record highs. Now, what did that do? I want to show you this chart that really concerns me. It pumped up. There. This is the S&P minis. It pumped up this. It gave this big pump in the stock market. It may be rolling over, and that's the problem of delayed reactions. Now it may be way too expensive. Once it starts reverting, it has that much more room on the downside. Now, in this chart, I show it with crude oil, but to me, that's the problem. Now we've pumped up risk assets so high, it's just those little lessons you learn in history that I showed you here, how expensive the U.S. stock market is. Mean reversion can be a powerful force, and sometimes it just takes a catalyst. When it's going to happen, I don't know, but I have to be honest. I thought it was going to start happening last year. I've been early.
And we're talking about mean reversion. What's the mean we're reverting to?
Exactly. So I think here is one. I'll show you that same chart right there. I think the S&P 500 can go back to 3,000. I said that last year. I've been wrong. That's, if you look here, this is tracking here. This is right about where it was right before COVID kicked in. Again, this is the orange. That's S&P 500. It bumped up to almost 5,200. And I think at a normal correction, it goes back to 3,000. Now, that's a big picture correction. But in the meantime, what I'm just showing is a little signal I see in the charts. This is just a little gap. The S&P 500 E-mini left. It's about 8% below current prices. It's never left a gap like that. Typically, that's what you do first. But normal bull markets, you have back and fill. And this is where my chart pattern recognition radar has been on high alert. See this rally here? It's been virtually without correction. It left a gap below, and it's been so excessively enthusiastic that I think it's the things I remember seeing back in 2007 and 1999, that it's just markets get too expensive, and then they have to mean revert. It just takes a catalyst, and the questions, I don't know what it'll be, but I think it's S&P 500 getting back to 3,000. Now I can, a year from now, if it's not doing it, I'll at least going that way, I'll give up. But I've been saying that a little too long. I admit that. But I show you on this chart how expensive it is. It's basically the most expensive since 1937 versus GDP. And it's the cheapest the most expensive versus commodities in 25 years.
Let's switch gears and let's talk about gold. You mentioned it already. Paint the big picture of the gold market activities for us.
Let's look at gold here. This is a monthly chart. And the big picture of gold is at the end of April, I'm showing gold closed at a record high for an end of month close. It's right now 2,300. I think gold is just a matter of time to go to 3,000. I can't tell you when. I don't know when. I think what was 2,000 resistance, which held for basically almost 4 years, from 2000 and beginning of this year, 2020 to 2024, is now support. So I think, if it dips near there, it's going to be good responsive mine. I think it's just a matter of time to get 3,000. But what I showed you in this chart is what's happening. It's that crocodile jaw pattern again. Gold's going up. And what I show you in these other charts is S&P 500 and Bitcoin going down. Now, I think Bitcoin's so significant because some people have called it the fastest horse in the race. It's the most widely traded, 24/7 traded risk asset on the planet. No other asset can say that. And Bitcoin is declining with the S&P 500. This is a monthly chart, and gold's going higher on a monthly chart. So to me, that's what I think gold's going to do. I don't know how long it's going to take, but I like to point out gold is the only major commodity going higher. And here's one key thing I want to point out is why I think gold is going to continue to rally. Is one thing to remember about gold, it basically outperforms all commodities over time. It's a question of when and how and over what time frame. So in this chart, I'm showing you this is the chart of gold divided by the Bloomberg Commodity Index. It's a ratio. It's a 20-year chart. You see that trend in gold? It goes from the lower left to the upper right. But what's significant, I think, about it, Kevin, is I'm showing you a chart of volatility in the U.S. Volatility, and this is the VIX Volatility Index. It's just a measure of volatility in the stock market. I just divide by the T-bill rate. But volatility is so low. A key lesson that I point out, I showed you how expensive the stock market is, and volatility is very low. There's the number one lesson I want to point out about volatility for our listeners and our viewers, and that is volatility is always mean reverting. So this measure of volatility I show you here, that's basically a 12-month average of the VIX. It's a volatility measure of the S&P 500. It's bottoming from a very low level. It's set the foundation for this very low level right before the financial crisis. This was a key indicator for me. It was one of my best trading years ever because of this indicator. And it's just a matter of time it reverts higher, which I think will make gold outperform most assets, including the stock market.
So we should be watching that. What else is it going to take for gold to accelerate? We have this interesting pattern of gold ETF outflows, right? And later we're going to talk about Bitcoin a bit, where obviously we have a lot of inflows. So that kind of already leads to that question. But what else is it going to take to reach 3,000?
I think more the same. But for number one factor would be a U.S. stock bear market, meaning could be a recession, doesn't have a recession, but just U.S. stock for investors to basically have a little bit of disdain for the U.S. stock market. We've not had that for over 10 years. We've had one of the most significant rallies in history on the back of zero interest rates, which pumped up assets too high. And now we don't have zero interest rates anymore. So the way I like to say it is in this country, certainly the U.S., is why buy gold when the stock market's setting records and you can get 5% in a T-bill. Now that might be changing. And that to me is what is the key thing that's going to transition. But it's to me, it's more of a question of time. But I'm concerned that what you mentioned with the ETFs, and this part of the reason it's kept me bullish, is it's one lesson in trading lessons is you always kind of want to focus on assets that are kind of out of favor, particularly if they have value. And we've never had this amount of gold ETF selling with the price of gold going up at the same amount or the same time. So for instance, the last, I think it's a year or two, total amount of gold ETFs have dropped in terms of ounces about 25%, and gold's gone up 25%. Now, gold ETFs have been around 20 years. That's never happened. So here's the numbers I put on it. There's been about 30 million ounces of liquidation in gold ETFs. At the same time, there's been over 90 million ounces of central bank buying of gold. And that's what's different, and that's what's significant. It's part of what's keeping me bullish gold. At some point, back to what started, I think, with this major shift in the world order with the unlimited friendship between Russia's leader and China's leader, it shifted the world order somewhat away from the fearful, U.S. dollar sanctions and things towards gold. And who's been one of the biggest buyers of gold? It's China. Not just the central bank, but other central banks. Turkey, the latest report from the World Gold Council is there was 290 tons of gold buying from central banks in Q1. That's the biggest, most significant Q1 buying ever in their database back 20 years. So central banks are buying gold. And central banks have the deepest pockets on the planet. They can print fiat currency and buy gold. So I say just go with that. But one thing I like to point out is from an investor standpoint, gold has been way out of favor. If you look at ETF flows, have been way negative, which makes me more attentive to gold. And we've just had these ETF launches, Bitcoin ETF launches in the U.S. There was a total in Q1 of about $12 billion of ETF inflows into Bitcoin ETFs. That set new standards. It set new records for new ETF launches, the most ever in a short period of time. It shows a little bit of excessive enthusiasm. And the way I look at it, Bitcoin had a bit of a perfect storm for higher prices, which was ETF launches. We had the cut in supply. We had record-setting beta, which now, as I showed you in that earlier chart, is we see gold making new highs and Bitcoin and commodity and stock market going down. I think this is more enduring than, at least for now.
I want to talk about Bitcoin in a second. First, to finish up this gold chapter, one audience question from Sean McKenzie 3337. Question for Mike. I read your post on gold, copper to gold versus China bond yields. With CGB 10-year yields seeing decade lows, where in Asia do you think investor demand could swing? Any optimism for Indian government bonds in the coming decade?
Don't know about Indian government bonds. I'm very bullish on India, partly because of the transition, and it's a GMTFO. It's an acronym I learned in the trading bits. Get me the heck out. Is happening in China, not just from the U.S. but Europe. There's a war in the background that Mr. Z could stop with one phone call with President Putin. So where's the tilt? Definitely in this country, it's all towards anything but China, nearshoring, reshoring. Significant imports are coming from Mexico now, in fact, surpassing that from China for the first time, and shifting over to India. Apple's shipped a lot of their production. It's just happening. So I'm quite bullish on India, but I don't know about their bonds. I am concerned that copper has just put in a peak around $10,000 a ton. I showed you how I think crude oil is peaking, and there's a very high correlation with copper and crude oil, and that's also all related to the stock market, but and global economic activities. But copper, Dr. Copper, which was mentioned, is a good indicator of global economic forces. And if you overlay copper in the U.S. stock market, they're almost tick one for one, and it looks like they're all kind of potentially peaking.
All right, let's switch to Bitcoin. What are you paying attention to in the short and long term?
Well, here's a chart I like to show you of Bitcoin, and here's a bigger picture going back to 2017. In this case, I'm taking Bitcoin divided by gold. I love using that ratio. So first of all, overall Bitcoin looks like it peaked pretty much, at least recently. It made that new high. It had good reason to make that new high. As I pointed out earlier, almost a perfect storm, ETFs, the halving, and beta making new high. But now we're in the hangover. Question's how long it lasts. But one thing I really like to use, if you take Bitcoin divided by gold, it's a good leading indicator. Remember, Bitcoin has been known by some as the fastest horse in the race, or been called that, and it is. It's higher volatility. It basically trades about 3 times the volatility of gold or the S&P 500. And it's traded 24/7. And you're seeing that more and more now. It's the one risk asset that's moving around on weekends. Now that's going to change. There'll be more of them, I think, trading because of the technology. But what I show you here is I think the key thing is Bitcoin is peaked. It's showing a peak versus gold. The high around 2021 was about 37 ounces of gold to Bitcoin. Right now, we're 25 ounces of Bitcoin. 25. It's peaked around 37 ounces of gold per Bitcoin. And right now, we're about 25 ounces of gold per Bitcoin. You see this divergent weakness? I'm concerned about that, because what I show you in this chart is Bitcoin gold. That ratio has a tendency to lead the S&P 500. That's what this is. And now it's showing divergent strength and weakness, which means they all might be heading lower. So we need to see a change there. We need to see Bitcoin, the most significant risk asset, trading 24/7 on a global basis, to show divergent strength versus gold. It's not showing divergent weakness. So that tilts me over. I'm still bullish gold, still big picture bullish Bitcoin. But right now, the biggest problem, I think, for Bitcoin is beta. And that means this U.S. stock market going down, and Bitcoin could be leading that.
Now, Russia is to enforce crypto restrictions. We just had these news exempting miners and central bank projects. I think the general sentiment in the Bitcoin and crypto community is that they don't see this as a big issue, because governments have been trying to ban or slow down crypto for a long time already. But nevertheless, we received an audience question, and I want to mention it here. Is it possible that Fed and all economic regulators of the world come together to ban the trading of cryptocurrency and decentralized currency?
Virtually impossible. It's one of those if statements. Yeah, if you want to trade on that, good luck. I mean, so there's certainties in life, death, and taxes. That's a very low probability. But just the fact, I wrote about this years ago when China banned it, and some things they recently kind of pulled back a little bit by launching ETFs in Hong Kong. And now if Russia's going to ban it, that's all more reason for the rest of the world, certainly U.S., to adopt it, because it's significant, rapidly advancing technology. And here's one thing that people misunderstand about the U.S. system. It's what Churchill said about the U.S. It's the Americans always come to the right conclusion after exhausting all available options. That's what we do. We beat the heck out of each other. It's called the checks and balances. Everybody has a view, and you have to hear the antagonist to understand the benefit. So let's look at facts. It's been banned in China, and the miners were kicked out, and just recently in the U.S. launched Bitcoin ETFs. Yes, it went through a lot of harassment, but it happened. And that's the key thing about American culture and society. If there's a rapidly advancing technology, that Bitcoin and cryptos are, that has money, votes, and is followed as a base layer, the dollar, and there's tax revenue, it's got to pass. It's just a matter of time. So don't worry about it. In terms of the U.S., they might do something stupid in the short term, but I like to point out the number one fact that people need to know about cryptos, which I'm going to pull up here in a second. I want to show you on this. I love the demo of this. This is coinmarketcap.com. It's one of the top crypto, I'm going to just expand it a little, crypto measures for what's happening in crypto. I need to give this examples. When you pull this up, you sort by market cap, Bitcoin's on top. When you sort by volume, the number one traded crypto is Tether. That's a US dollar token, $110 billion. Now, if you're in the US and you're a regulator or legislator, are you dumb enough to mess that up? Those $110 billion, most of that's in treasuries. It's one of the biggest treasury holders on the planet now. It's one of the most profitable companies. It's just one token tracking the buck. So the whole space has gone organically for the dollar. To me, that shows how strong the dollar is. It didn't go for the yuan or the ruble or the yen or the euro. It went for the buck. I mean, people call them stable coins. I call them crypto dollars, just like euro dollars. So that's the number one thing to remember from this space. In terms of regulation, you see why Russia and China are pushing back on it, because they're dollar haters. That's why they're going for gold. But in terms of the U.S. isn't going to mess this up. Went for the dollar as a base layer. There's tracking treasuries. There's a lot of money. There's a lot of votes. And what did the U.S. do? Just approve Bitcoin ETFs. But we had to beat each other beat each other up first, which is the American way.
Very interesting insights. I want to switch gears and talk about oil as a last thing. We kind of already touched upon that at the beginning of the interview. I want to quote from your Commodity Outlook May edition published on the Bloomberg terminal yesterday. Quote, CGB to JGB yield convergence and crude headwinds. Government bond markets can be profound indicators, and Chinese government bonds show a deflationary recession tilt with implications for crude oil Elevated equity and property prices in the process of reversion in China have echoes to Japan from about 30 years ago. Explain why government bond markets can be such powerful indicators and what are the implications for crude oil in this case.
It's a lesson in life, and certainly when you're dealing with China, ignore what they say, watch what they do. So again, I'm showing you this here, this chart in white, that's plunging bond yields in China. I mean, they can fully expect it's completely respect for China, its future and history. China is one person right now. It's completely autocratically led by President Xi. And by that nature, it's virtually impossible he's going to get proper information, because if you give him something he disagrees with, you suffer. I mean, it's part of what you learn in corporate America, in corporate businesses anyhow. If you don't deal with what the boss says, sometimes you're out. So that's what I show you here. So one thing you can trust is bond yields. And plunging bond yields in China are indication of severe deflationary forces. All other data from China, you have to be very careful. I mean, there's no checks and balances like me. I mean, I can push back on a Bloomberg terminal of any piece of data I see coming out of this country and not have repercussions. That's what makes our system better, is we check everything. And we dispute it, and we come to conclusions. In China, you don't have this. I'm pointing out JGBs our CGB yields are collapsing. That's a sign that China's heading towards a normal reversion of a rapidly expanding emerging market that's way overdue. It happened in Japan 30 years ago. Soviet Union collapse is another example. And to me, it's just a matter of time. So that, to me, is the key macro big picture. Then I want to show you something, same thing. This is one thing that's happening is I'm showing you is China imports of crude oil right around, 11 or 12 million barrels a day, somewhat dropped down and stagnated, but it surpassed imports from Japan around 4 million barrels a day in 2009. But if you look at the spread between CGBs, Chinese government bonds, and JGBs, Japanese government bonds, it's now dropped to levels below 2009. So it shows China's heading towards what Japan did. And here's another key. That's the macro big picture. Here's a shorter term picture. I love when people talk about OPEC. OPEC does not set oil prices on a global stage. They do for some of their customers, but they're a diminishing part of supply. The massive biggest exporter and producer of energy now is the U.S. and Canada combined. That's what's shifted. And what sets oil prices are leveraged futures, hedge funds. And this is what I show you here. It was my indication I put. This is a sell signal I put recently. This is total petroleum futures positions bumped up to around 15% of open interest. That means the market was way too long with hedged leverage funding. These positions were way too long. The pendulum was like, well, we're so bullish. That's what happened last year, 15%. Crude oil peaked at 95, and it dropped down to 69 or so. We just did that a few weeks ago. Crude oil peaked around 87. This is WTI. Managed money net positions in most of these petroleum futures got as expensive as they did, as long as they did last year, and petroleum's starting to roll over. So to me, that's my sign for all commodities. I show you that here. I think commodities this is a Bloomberg Commodity Index, is rolling over. Japanese government bonds are collapsing. Here's the problem. Commodities are really cheap versus the S&P 500. But the problem is the S&P 500. And this, to me, is the problem now, is crude oil is potentially peaking at the same time the S&P 500 is, and you absolutely have to have the stock market go up for crude oil to stabilize. What if the stock market goes down? It's a double whammy. And the point is, I just want to point out, I'll end with this. The number one measure of heat, electricity, and fertilizer in this country is natural gas. And natural gas in the U.S. dropped this year to a price that was first traded in futures in 1990. That's 34 years ago when futures first started trading. That's a classic example of the high price cure. They got too expensive. It brings on supply, cuts demand. You sure felt that in Europe. And now we headed towards the low price cure. So one commodity, it's a major commodity in this country that has already at least bottomed from that low level. It was around 1.6 million BTUs. Now it's almost 2. It's bottomed. It got too cheap. Crude oil is going to do that, I think. And I think it means WTI crude oil is going to head towards $50 a barrel rather than sustain anywhere near above 90.
I think that's a nice segue. I want to be obviously respectful of your time, but we have one more audience question there, which is by Genjuro SE. What connection does Mike see between commodity prices and PCE or CPI?
I appreciate that's a good question. I like it because commodities are a good leading indicator for PPI, producer price index has dropped. Let's just pull that one up. It's dropped to negative. PPI year. This is one of my favorite charts. GP have dropped to negative this year. So commodities are a good indicator for. It's going to take a second to bring it up. Let's max this out. And the beta, I mean, the measure PPI is a good leading indicator for most PCE, most CPI, and other indicators. So the beta is about 2 to 1, PPI to CPI. This peak here is what you'd expect, the highest almost ever. You have to go back to the 70s. And now we're collapsing. PPI actually went negative. And I think it's just a matter of time it stays down and goes lower, and all inflation collapses lower. And that's what you expect after you go too high. It gets low. Now, this took a little while, but this was something that in the 70s, this took decades to get here. This took 2 events. One major event was COVID and massive liquidity pump. Now we're dumping. So I think it's a matter of time we're going to see pretty severe deflation. PPI has already gone negative. That was last year when crude oil dropped. I think it's bouncing and it's going to go negative. I think we're going to have deflation, negative CPI, negative PPI, potentially personal consumer expenditures. It's hard for that to go negative. But for these measures, because the base went too high, and now we're measuring from such a low base, once we get the stock market to go down in recession, all these measures drop down into deflationary forces, which is completely normal and completely what you'd expect after the biggest pump in liquidity ever. That's dumping.
Mike, this was incredible. A lot of wisdom. Last questions. You have been in the markets. You've been analyzing the markets for decades. You have a broad set of experiences. What are your favorite wisdoms that you have accumulated over your career?
In this case now, I like to point out what I mentioned earlier. The most powerful force in markets can be mean reversion. 1987 crash in this country was a simple mean reversion event. 2000 to 2002 bear market in the stock market was a simple mean reversion event. 2007 to the low in 2009 was a simple mean reversion event. Mean reversion is probably just kicking in. And when you get levels that, as I showed you, are at 25-year, 50, multi-decade extremes, just look for a catalyst and invest accordingly, but be very careful overweighting expensive risk assets. And that's part of the reason I think gold is still going to be one of the best performers. That mean reversion potentially will happen. It's just a question of when. And I showed you the low volatility. Number one lesson of volatility is always mean reverting. At some point, it's going to pop up. Here's the way I like to describe it. It's a tinderbox looking for a spark. I don't know what the spark will be. I can guess. But it helps you allocate your assets accordingly.
Mike, last question. Any books or resources you recommend consuming, except for a Bloomberg terminal, of course?
Yes, well, definitely a Bloomberg terminal. There's dozens I've read lately. The book that I found most profound, I read a few years ago, was The Price of Tomorrow by Jeff Booth, pointing out how technology is moving so rapidly that what is BYD doing to Tesla? What is Huawei doing to Apple? Just exactly what he predicted. Technology is moving so fast and so rapidly. Your risk is falling behind. You got to stick with it. And another book I think really mattered a lot was called The Domino Effect by Brazil was his last name. Just how crude oil production should continue to move rapidly. There's so many of them. A book I just read I enjoyed recently was The Party, about Chinese Communist Party. I forget who wrote that. Chancellor might have written it. Another one was The Price of Time. Forget who wrote that one. But that's one thing I do. I have really kicked in a lot lately is reading a lot about mostly China, because I have a strong opinion there of what's happening. And those to me are some of the most recent ones that I just right now I'm reading Broken Money by Lynn Alden. This kind of example of what's happening with Bitcoin and crypto assets. Good history of the dollar and currencies and fiat currencies. But there's just a few I think that are significant. But one thing I think it's so important is now is a good time to brush up on all the history of markets, because we are at such extremes. That's why I point out the macro, and then the micros you have to tilt down to what's going to tilt towards this mean reversion that I'm worried about, which is just a normal cycle.
Mike, this was great, very insightful, and also very educational. Where can people find you?
Well, I'm on Bloomberg Terminal First. On Twitter, I'm at Mike McGlone 11, and on LinkedIn, Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist. And if people want, you can reach out to me on and send me your email. I can happy to add you in my distribution list.
Thank you, everyone. Don't forget to leave a comment, subscribe, and like. Until next time.